Hello and welcome to another episode of The Long and Short of It. I'm Patrick Ceresna, joined by...
Nick Galarnik.
We didn't practice that, but that's cool, Nick.
Yeah.
Anyway, great to have you back on. But listen, we're gonna take a dive right into these markets. I have a great options strategy I want to share with everybody, and you can pick my brain on it, and let's kind of see the opportunity I'm thinking. But let's start off actually just talking about these markets here briefly, because I think this is really interesting what's going on. So here I'm going to just share my screen, and what I have up here is that chart of the S&P 500, and this thing has been resilient but boring. Like, this thing is still at its 52-week high, but hasn't broken out. And so we've been in this multi-month trade range, and the markets are stuck up along those highs. And it'll be really interesting to see whether the next big move is a bull breakout on the upside technically, which I would think has the upside maybe towards 6,400 or so if we did break out. But the market's very heavy and tired, and the breadth of the market isn't widening. The Mag 7 stocks are not totally participating. So it's one of those kind of crossroads where, the market's going to have something really drive the leadership of a bull advance. And at least at this moment, it's not clearly evident to me where that would come from. What are your thoughts here on the markets?
I think we're in a holding pattern for a bit right now, as we approach that monthly OPEX for February, so this coming Friday. And at that point, I think we're going to see an unpinning into the April OPEX, possibly more volatility introduced into the market. And I do think we see perhaps a decline down to around that 5,800 area. But we've been bouncing in this area for the past, few weeks roughly. And with Trump in office now, we're seeing a lot more volatility introduced in the market because of these random headlines that come out midday during the market, right? So you see Trump comes out and says, hey, I'm going to add a new tariff to X, Y, and Z product with ABC country. And what does the market do? It responds or it doesn't respond. And you're right. I think we're overextended. The Mag 7 overall earning reports, in my opinion, were very, very weak. Like Google had a weak report. Same with Microsoft. Same with Tesla. So there were a few names that were stronger, namely Netflix. But again, you can't have an economy built upon a streaming service, for example, right? So doesn't matter so much. I mean, right now we're seeing a detachment from fundamentals. Like if you look at the Schiller PE, historically, the average is around 17. The median is around 16, and right now we're at like a 39. We're like at the second highest point in all of history. The last time it was this high was 2001, roughly, right, or 99-ish, right? So like the .com bubble. And I don't know what's going to cause a dip to occur, but what I'm seeing is that valuations, are very, very stretched, and the fundamentals are just not there to support the valuations.
No, it's interesting about that Schiller PE ratio perspective is that before you could justify very high valuations in the markets because interest rates were zero. So when you're using the discounting of interest rates, ultimately any multiple for those earnings against a zero interest rate was a no-brainer. But now you have the risk-free rate of interest in the 4 to 5% range. You have and especially doesn't seem like it's going away. That's a part of the trade I want to talk about here today. But when you're talking about the risk-free rate of interest in 4 to 5%, suddenly those kind of multiples, that's pretty rich. I mean, you have to have some pretty robust growth expectations of the markets in order to justify that kind of a multiple. It is certainly something that has to be in the back of the mind of what's going on in the markets. Are there any other things that you're watching on the markets before we get into interest rates?
Right now, I've been on vacation for the past few weeks, so I haven't really been as active. But I am looking at shorts on a few names, namely Tesla. I caught a nice short on that via inputs from 400 down to around 340 or so, and it bounced back up again. But again, like when I see fundamentals that are so detached from reality and sentiment around a business, for example, as Tesla, detached from reality, where consumers are shying away from buying EVs from Tesla now, and that's the brunt of their business overall. How do you justify a valuation of like $1.25 trillion when they're seeing declining sales. Like, that's just one example, right? And I'm not trying to like harp on Tesla,
Yeah.
but across the market, you're seeing a lot of frothiness, and like names like Palantir. Like I love Palantir as a name. I've been holding it for a long time, but I've trimmed most of my position now because I don't see valuations or the valuation of Palantir being justified at this time. Now, I could be wrong, obviously, and it might run to 250 a share, but I'm thinking that we see a correction at some point. I don't know again what the cause will be, but historically, valuations can run frothier and frothier, but at some point they might come back down again by 30, 40, 50%. And I don't want to be caught in that. So I'm playing more more cautiously right now, taking small stabs here and there, using put spreads or call spreads, and not risking too much of my portfolio. I'm heavily in cash right now, and also in a lot of gold, because I do think gold is going to be an appreciating asset over the next 5 years roughly. I have a longer term target of 5,000, but that's neither here nor there.
No.
But yeah.
Perfect. Well, listen, let's. I think that when you're bringing up a lot of the topics we talked about just in the last 5 minutes, it has a lot to do with what the market is anticipating in regards to the Fed path, where interest rates are going to be, and the impact of tariffs and the policies of the existing administration, its impact on the economy and to the global economy, because a lot of countries have a lot of uncertainty associated with it. So let's take a dive into this, because I'm really I'm in the camp that uncertainty slows economies. And so when businesses do not have clarity how things are going to be moving forward, they hold off on making decisions on businesses until they have further clarity to act. And they therefore aren't hiring as much. They trim their employment. They lean everything up, and often that kind of a contraction can be often associated with economic slowdowns and or recessions, right? A lot of people have this big anticipation that that Trump is this big business stimulus. To a business-friendly administration that's going to get things fired up. But what is clear is that he has a very big agenda of reshaping the world and reshaping the way America is playing in global trade and everything. And that, in fact, I think is actually going to cause short-term pain before their long-term benefits of this become evident. And to me, I don't think that the market is pricing that in right now. And that's where I want to go today, Nick, is I want to talk about SOFR futures. And to be honest, vast majority of stock traders and many people listening to this may have heard the term SOFR, but it might be something brand new to
Absolutely.
them, right?
I mean, I never traded SOFR futures in my life, and I've been trading for over 20 years. So yeah.
Well, I'm gonna go down the thing, because it's not only about SOFR futures. We're gonna trade options on SOFR futures. So
more my speed right there. More my speed.
Yeah, there you go. And so we're gonna go down this rabbit hole for our listeners and kind of explain this in greater detail. Okay, so first of all, what is SOFR? SOFR is a newer term because they replaced what were known before as Eurodollar or Eurodollar futures. And Eurodollar futures existed for international bank overnight lending rates that were out there based on LIBOR, which was that London overnight lending rate. And that transitioned over the last half a decade into now all being globally standardized under this SOFR. So Eurodollar futures don't exist anymore. Now they're SOFR futures, but they are the same thing in a continuation of it. And so SOFR, which is the secured overnight financing rate, is what is the rate of interest that people are paying, or banks are paying between in each institution for overnight lending of money or borrowing of money. And SOFR is actually now calculated by the Bank of New York. They're the ones that are determining this rate. So when we're trading SOFR futures and or anything associated with SOFR, it is the short-term interest rate, or STIR market, short-term interest rate market. And so it is about the anticipation of where short-term interest rates are going. And the most interesting part about that is that who is the sole decider of where interest rates in the U.S. go?
Yeah.
The Fed. Yeah. And so really, this is us betting on what the Fed's going to do. So when you're in the SOFR futures market, you are more or less anticipating or trying to anticipate where interest rates are going to be at some future point, as they're pretty much determined by the Federal Reserve. And this is a gargantuan market. To put it in context, you might have heard, in whether you watch a Big Short movie or some other doom porn guy that goes out there and says there's $700 trillion of derivatives that exist in the world on there. Well, the reality is all of these derivatives that really exist, the vast majority of them are associated with interest rates and currencies. So all of the global banks and everything are either hedging interest rate risk, currency risk, whether it's swap markets or whatever they're doing, the vast majority. And so this is one of the largest markets in the world, the interest rate futures market. And so you have the single most liquid market in the world. And so when, as a retail investor, you're coming in there, you don't have to deal with illiquidity at all. Like, you're coming into a market that is incredibly liquid under a lot of circumstances, and therefore, and because interest rates are controlled by the Fed, the interesting part is that therefore there's not a lot of risk that interest rates are going to make extraordinarily big moves, and so the type of leverage that is available to you in this market is extraordinary, and so you could come in there, have a $250,000 of notional exposure on the SOFR futures, and they're asking for collateral of less than $1,000 to collateralize it, right? Like, you literally can come in there and lean into large interest rate calls in there. So I want to talk about the idea of using a call option anticipating the Fed path. But in order to first of all, do you think there's anything I didn't cover here, Nick? Is there or did I do a pretty good job explaining it so far? Because I think you
explained it pretty well overall. Yeah.
All right. Because if there's something that you think our listeners need clarity on, please feel free to just interrupt me halfway through, because I want to make sure that when we go down this rabbit hole, that we're explaining it very clearly along the way.
Absolutely,
right? Yeah. And so let's talk about a SOFR futures chart that I'm going to put up here. And so this is the March 2025 SOFR future chart. And you could just get on TradingView or anywhere, but you can go to all different months. Now, what this is talking about is they're looking at the 3-month lending rate, a 3-month future. And this one is the one anticipating where interest rates are going to be priced out to March next month. And the way that this is simply calculated is always, you want to think when this chart is showing you 100, it's a zero interest rate. So when right now this is being priced at 95.70, I'm rounding here, it's at 95.70. The difference between 100 and 95.70 is 430, right? And so basically the interest rate is 4.3%. So you literally can determine what the interest rate on being priced in by simply always minusing the euro-dollar price on the future. 100 minus that amount is the interest rate that they're currently trading. And so on this chart, for instance, back in September, when we were trading at 96.70, then back in September, they were pricing in a certain amount of rate cuts into the market that was basically having the interest rate at 3.3% looking forward into March. And since then, those interest rate cuts have been pulled out of this market. I hope that adds clarity in terms of just how this market is priced. And so in the end, this is basically a prediction of how many cuts there will be in a certain period of time and what the path of that interest rate will be. And so what's interesting is I'm going to go here to the December of 2025. So we're now going forward about 10 months. Okay, Nick? And so we're looking 10 months into the future. And we're looking at where does the market what is it currently pricing the anticipation of where interest rates will be. And you can observe it's priced at 96, which is essentially they anticipate interest rates to be around 4%. So what you can observe between March to today, they're anticipating about one interest rate cut, right? Where they're saying the Fed will cut interest rates 25 basis points, and we will, at the end of the year, be somewhere around 4%. The interesting part is obviously in the last year and a half, we had two huge kind of shock points in the market that caused everyone to believe the Fed was about to start a huge rate cut cycle. So back in October of 2023, when the last leg of the bull market really got underway, was when everyone was anticipating the Fed pivot and the cut cycle imminently coming. And during this period, they essentially priced in almost 200 basis points of rate cuts by the Fed. They literally came in there and suddenly said the Fed is about to start cutting. We have to. We're gonna see a dovish Fed, and we need to price this in to interest rates, 1 or 2 years forward. Then when things got really dovish and the Fed was hawkish, or things got hot, and the Powell came out very hawkish and saying, slow down, you guys are anticipating these cuts coming too quickly. The market proceeded back in the first half of last year to pull all of those rate cuts back out of the market. And so basically we went to pricing in 200 basis points of cuts to pricing nothing in. Then the market had another freak out. We had the yen carry trade blow up. Suddenly it looked like the world was ending, and the market in the summer of last year goes to once again pricing 200 basis points of rate cuts back into the market. Everyone's super dovish, thinking the Fed's about to start cutting. And then suddenly they pull everything back out of the market. And so we find ourselves today with a market that is basically predicting that, or anticipating, or pricing in that the Fed is going to have very little to no action all year long. One rate cut is all that's being priced in right now. But what's crazy about this, Nick, is if you go out to 2026, one additional year further, we're still at 4% interest rates. In other words, the SOFR future market is at this moment pricing in a Fed that is going to do absolutely nothing for the next 2 years. And I think that this is spectacularly wrong. And I feel that there's we can never talk in certainties, but there's a real legitimate chance that tariffs and global uncertainty and everything will actually have a slowing effect on the economy. And everyone with this, and if that's the case, the Fed will have to be more dovish and will have to ease even that much more to counter that. Now, the key here about the SOFR futures market, it's not actually what the Fed is going to do, but rather what the market is pricing in that the Fed is going to do. And so as of this moment, I'm betting that everyone that thinks that the Fed will sit on their hands and do nothing over the next year or two, there's going to be a point in the next few months where everyone's going to say, holy shit, things are actually going to be a little bit slower, and the Fed might be forced to actually start cutting interest rates? And if that's the case, we have to price it in, and we should see these SOFR futures actually rise. And that's what I want to bet on today. And I want to talk about options on how to take a position that we're going to go from a Fed being very neutral to no rate cuts being pretty much priced in, to once again going to a point where 100 to even 200 basis points of cuts are going to go in. Any questions of this? Do you think I explained it clearly to our listeners?
Just to like kind of reiterate. So basically, these futures essentially will go up if the Fed cuts rates, because the 100 point is where rates are at 0%, right? So right now at 96, it's 100 minus 4, which denote 4%, right? Yeah. And so basically, by thinking that the Fed's going to cut rates, we're going to regress toward that 100 regress toward that 100 area, which would cause SOFR futures to actually go up, which is why you're buying a call option.
So right now we're at 4% out here to December 2025. If they were pricing in 100 basis points of cuts, that the Fed has to cut an extra 1%, then this would jump up to 97. Yep. And if they were pricing in 200 basis points of cuts, we would get all the to a 2% interest rate. We'd get up to 98. And so I want to talk about buying a call option that would profit from this type of a move. And so we're going to look at
and also given that not many people are pricing this in, it should be a relatively cheap trade, right? That's what I'm assuming.
Well, let's look at that risk-reward proposition of this trade and actually see what this looks like to be able to do this. So now, of course, you could just go and buy the actual SOFR futures themselves, right? They allow plenty of leverage. You want to take on the risk, you can just go and buy these December 2025s and just bet on this purely in the futures market in a Delta 1 environment where everything is going to be functioning like a normal futures contract or like a stock. But I want to buy a call option, and the call option gives us the convexity where we don't have to stress about if we're wrong and they're going to start raising interest rates because inflation's starting to run away or some other factor that comes in there. We want to outlay a fixed amount of capital to buy an option to make this call on it. And we're talking something longer term. This is an option that's going to have 200 plus days on it that is going to be open for the rest of the year on simply a call that the market needs to price in a more dovish Fed. Remember, we don't actually need the cuts to actually happen. What we need is the market to say the Fed is going to have to cut and then price it in. And so we're anticipating how the market is going to pivot on that view. Okay, so let's talk about options on futures and how they differentiate than normal options. So the one biggest thing that our listeners need to understand, Nick, is that in the futures market, everything has different multipliers. For instance, S&P futures have a 50 multiplier, and gold has a 100 multiplier. Silver has a 5,000 multiplier. Like crude oil has a 1,000 multiplier for a number of barrels. So in the futures market, the multipliers shift. So everyone in the stock market that trades options just always knows it's a 100 multiplier. The option's for $1. It's going to cost me $100 to buy this call option. In the futures market, you always have to be cognizant of the multiplier. And so when you're seeing a quote on a SOFR future at 96, it has a multiplier. Let me just actually right click and look at the description, financial description. It has a multiplier of 2,500. Basically, 2,500 times, let's just, for rounding purposes, multiply by 100 means that it's basically $250,000 SOFR future contract. Now, in the same way, when we look at a quote on an option, we're going to multiply whatever the price we see times 2,500 to determine how much it will cost us to buy one of these options. And so this is the first thing to understand about future options on futures, is that element. The second thing is that let's talk about in the stock market, what are the 6 option pricing variables? The stock price, the strike price, the amount of time, implied volatility, interest rates, and dividends. right? That's these six math variables come into the algebra to determine what is the price of an option. In the futures market, though, a couple of things have to be accounted for. Number one, the term structure of futures basically discounts all interest rates into the futures contract itself, including dividends. So in the math inside an option, rho is non-existent really, or any of the dividend variables, because it's already priced into the future, because we're talking about an option already on a derivative, and the derivative has already been priced for that. So we are only ever dealing with the four core variables of the price, the strike price, the implied volatility being priced in, and the amount of time. So it actually makes the math a little bit simpler because of that underlying element, all right? So other than that, if you can get past the multiplier element, then trading options in the futures market is exactly the same as trading options in stocks, in terms of you buy myself one contract, three contracts. Time decay is my theta burn is this, my impact to vega or volatility is that. Like, all of these variables are going to behave the exact same way.
And they're cash settled too, right?
Depends. In fact, some of these futures actually will settle the futures contract. So the futures contract delivered to you, and then if it's a physical delivery, for instance, Interactive Brokers does not allow physical delivery, so they'll force you to close the futures contract. But many of them actually will deliver the futures contract to you on settlement. So let's talk about this SOFR future. So right now, what I have here is basically a call option that is out till December 12th. Right, so the OPEX for this futures contract is the December 12th of 2025. Okay, and so actually, if I just pull up the options chain, what you can observe here is 298 days, and even then, what they'll do is they'll put the 2,500 multiplier right up here, so you can even know what it is. So how many days and what the multiplier is on that. So when we know that that this is a $96 price for the SOFR future is saying a 4% interest rate, when we see that this December call option at the $96 strike is trading for 30 cents, it's really 30 basis points. Basically, one rate cut. With one rate cut being 25 basis points, we are basically being charged 30 basis points in order to own a call option for the rest of the year, anticipating that the Fed will be forced to start pricing in a certain amount of rate cuts that need to happen toward the end of the year. And so, in theory, if we even have a move where the market prices in anywhere from 50 to 100 basis points, this could easily be worth 50 cents to $1 of just intrinsic value. Forget about time value components on there. And if they go pricing in 200 basis points of cuts, you're talking about turning 30 basis points into 200 basis points. You have lots of room to really compound the return on that call option, and the most it will cost you is the 30 cents. So just to illustrate this, if this is by a simulator to count, so it doesn't matter if I actually do the trade on here, but let's just say I'm going to buy this one call option at 30 cents. It has to be multiplied by the multiplier of 2,500. So this is actually going to cost very close to $750. Yeah. And so if I come in here and just buy this on market just to show everyone, you can observe it's a $729.29. So $729.32 is basically what it's pricing. And you can observe here is that one call option to control was a $700 capital outlay for controlling this call option. And so this is and you can see from a delta dollar perspective, because it's very close to a 50-cent delta, or it is a 50-cent delta, it's basically 120,000 delta dollars of notional, delta dollar exposure on this position anticipating that thing. So anybody who wants to come into these SOFR futures markets, you can come in here, whether you do the future itself or an option on it. It's once you can wrap your head around the simple thing that it's simply whatever the interest rate, 100 minus whatever the interest rate is, and you decide what you anticipate or feel that the path of interest rates will be. You can come in here and buy one of these options. You can do spreads, you can do whatever way, you can do your butterflies and condors, whatever you want in there. It's a very liquid market, and it's a great way to play something that anticipate that direction. So my idea for this episode was that I feel that the market has to price in a much more dovish Fed moving forward, and that the SOFR futures are simply not pricing that yet in, and there's a asymmetric opportunity to play the market having to pivot to a more dovish Fed.
It's a very interesting idea. Yeah, I actually like it a lot. I wasn't even aware of this at all whatsoever, so I appreciate you bringing the
there you go,
the information to me.
Yeah. Well, listen, it's a great market. I personally think it's way simpler than trading Treasury bond futures.
Yeah.
Treasury bond futures have like bond pricing and all these different things are a little bit more complicated. Often you need a Bloomberg machine to turn that noise into some sort of sense, and not the average retail investor doesn't necessarily always have a Bloomberg machine to do all of it. But yes, SOFR futures are so simple to understand. Therefore, I would say that a retail investor should 100% be going into SOFR futures before they go into Treasury bond futures. Like I'm not saying you do either, but I'm saying if you do, SOFR futures are much simpler, much easier to understand, easy to chart.
Limited risk
all
too.
of that comes in there. Yeah. Absolutely. And even then, you could even play the term structure on it, where basically you believe, for instance, interest rate cuts will be much farther out, like a year out, and that the market is too dovish too soon. You can literally short the one, go long the other, betting on the term structure shifting in terms of when the Fed rate cut cycle will be. There's all sorts of really cool strategies you can do. I'm obviously making this rudimentarily straightforward, but I think that that's an important starting point.
You probably even pair trade it with like TLT, for example, something like that, which is longer term, by selling out of the money, call spreads or something like that, and financing your SOFR trades with that money, like as an example, right? Because then you have limited exposure to risk on TLT, and then you'd have I guess infinite upside on
the
SOFR.
Yeah, you can definitely do that, but one has to be just simply aware that long-term interest rates are actually far more sensitive to inflation paths and what longer-term inflation expectations and growth expectations are, while SOFR futures are much more a trade on what the Fed is about to do. And so while there is a correlation, that this is where yield curve steepening and yield curve flattening and inversions and all of these different things are happening because of that divergence between long-term rates versus shorter term. But long as you can get down a certain amount of correlation, then you can certainly pair them as a trade opportunity. But that's all I got, Nick. I mean, if there's something you think we should still cover. But
it's a very cool idea. I like it a lot. I think that if the tariffs result in higher inflation, then you look at, perhaps, the economy slows, the Fed has to react by perhaps cutting rates, even though it's counterintuitive because inflation being higher should usually result in rates being higher. So in that case, SOFR futures would end up going up, right, which would be productive for the call option for December, right, this year. So that makes a lot of sense.
The way I kind of round that is that there's different types of inflation. And if you remember a few years back when the Fed was obsessed with using this word transitory inflation, well, to me, the very definition of transitory inflation is tariffs, because what drives real inflation is money dilution, money supply, credit expansion, all these different things running, and that can create that sustained inflation that the Fed is really trying to fight. But if there's a tariff that comes in and prices rise because of it, it's not something that can be fought with raising interest rates to cool things off. It's not. It's a transitory print that is manufactured by Fed policy. No, sorry, by government policy, but it's not something that the Fed has to do something about. And so I could see a scenario where inflation is higher because of that transitory influence.
But rates go lower.
But the Fed won't act upon it because it's not something they can fight with rates. And that is, and that's the interesting kind of thing that has to be done in the calculus in your brain in terms of, you don't want to make things as rudimentarily that CPI is up and therefore rates are about to be, jumped higher to fight it. It's not always that simple.
And also back in, I think it was 2020 or 2021, they introduced the average inflation targeting as well, right? Which was like the, I think it was like 2 or 3 year average of inflation, and they would pretty much use that as their measure of if to raise or cut rates or so. So it makes sense. And not to mention with tariffs, I mean, they can come and go very fast. We saw with, Canada, Trump was threatening tariffs, and all of a sudden, within like a couple of days, it was like, okay, we're going to push them out 1 month. And then come March 1st, which is only, what is it, like 11 days away or so, you might say, okay, well, tariffs get pushed out again. So those can go away as well, right? So yeah, the volatility being priced into the SOFR futures doesn't seem to be too great overall, and as a result, that's where the opportunity resides, right? Like, you're risking this small amount of money, and if you're correct, let's say we get, let's say you get a black swan event again, like a secondary pandemic, and they go to zero. All of a sudden, that 30 cents is worth $4, right?
Yeah, that's that's exactly it, buddy. That's what there's asymmetry in that trade. All right. Listen, thanks everyone for joining us. And Nick, listen, if people want to follow you, where can they find you?
At my website, optionfinity.com. That's optionfinity.com.
Perfect. And you can find me at bigpicturetrading.com, and definitely follow this YouTube channel, Patrick_Ceresna. All right. Thanks everybody. And we'll be back in a couple of weeks with the next episode.
Thanks, guys.
Thanks everyone. Thanks, Nick.